The information contained in this podcast is an expression of opinion and does not constitute investment advice. This is the Gold Money Podcast with Felix Moreno, keeping you up to date with expert opinion on precious metals and the markets.
Hello and welcome to the Gold Money Podcast. I'm here today with John Williams, economist and founder of shadowstats.com. Hello, John.
Hello, Felix.
It's an absolute pleasure to have you here on Gold Money. As you know, we look at your website a lot. We use your stats. In fact, James Turk's Fear Index uses your M3 calculation, which thankfully you continue to produce despite the government discontinuing it. So can you tell us a bit about why you founded ShadowStats and why you feel that it's important to try and give an alternate statistic to the ones that the government provides?
Well, I've been a consulting economist for over 30 years, and I found some time ago that the government's statistics in terms of the economy, in terms of inflation, increasingly were varying from common experience. And as I look closely at the numbers and methodological changes that had been made that tended to, again, move these numbers away from reality, I decided to try and put forth estimates of what these numbers would be without a lot of the recent gimmicks that had been added to it, so that people had a better sense of where the economic and inflation reality was. The average person in the United States recognizes that inflation as it comes out of the government is understated and that economic growth is overstated. They don't necessarily know why, but it's extraordinarily important, particularly with the inflation numbers, that you have a good sense of what's being reported. Most of the differential here between what the government reports and what the average person would think of, let's say, in terms of inflation, is definitional.
So, John, US CPI, according to ShadowStats, according to your SGS alternate CPI, is being reported by the government as being 2 or 3% lower than you calculated. Is that correct?
At least. Here's the problem. The way most people view inflation and the measure, I mean, if you're using this to adjust your salary, if this is something that you're looking at as a target for your investments, you want to stay ahead of actual inflation. You want a measure of inflation that, number one, measures the cost of living, of maintaining a constant standard of living. And two, you want it to reflect at least your out-of-pocket expenses. And that's the way the inflation measure was for decades, and in fact was the case on various consumer inflation measures and indexes that have been constructed over centuries. But recently, the U.S. government has changed that whole concept. Back in the 1990s, Alan Greenspan started making a lot of noise about how the CPI, that's the main inflation gauge published by the U.S. government, overstated inflation, and that if only they had a more accurate CPI, which would be lower, that would enable the government to reduce its budget deficit some, because it would mean that the cost of living adjustments to Social Security would be lower. If you ask Mr. Greenspan why the inflation number was overstated, he'd use an example that, if beef steak gets too expensive, people will buy more hamburger. And if they buy more hamburger, that's cheaper. It reduces their cost of living, but that's not reflected in the CPI. Well, it's not reflected in the CPI, well, at least was not traditionally, because the way most people viewed the CPI and the way it had been used for decades in auto union contracts and such was that it measured the cost of maintaining a constant standard of living, and that's what you want. You want to be able to, at least to live the way you did the year before, by changing the concept to allowed substitution of, let's say, hamburger for steak, the CPI no longer reflected the ability to measure a constant standard of living. Second factor is out-of-pocket expense. In the 1980s, the U.S. government started to introduce the concept of hedonic quality adjustments, where they would go in and change the way the different costs were weighted. If the government deemed there had been a quality change that could not be directly measured. The government does measure direct quality changes, and appropriately so. Let's say 1 month you have a candy bar that's 8 ounces in a certain size package. The next month it's in the same size package, but it's only 6 ounces. That's something that the government can directly adjust for mathematically, and the people who survey all the goods on the shelves and stores and such look for things like that. But when there's a quality change that can't be directly measured, my contention is you should just reflect what people are paying out of pocket rather than try and second guess human nature. An example, early on, the U.S. government had mandated a change in gasoline formulation to generate cleaner exhaust from automobiles. When that change took place, it added 10 cents per gallon to the cost of gasoline, which at that time was a significant portion of the cost of gasoline. But the government did not count that in inflation because it deemed the mandated change there as a quality improvement. But I can tell you that the average person who is filling his or her gas tank wasn't thinking, "Oh boy, I'm paying more now to get better quality air," moaning and groaning instead about how much more it was costing to fill the automobile with gas as they drove to work. There are a whole series of examples like that. But the difference is there, if you look at what the government has done, when they've made the changes, they've usually been pretty open about it. They make estimates as to what the changes have done to the reporting of CPI. If you take all the changes that were made since 1980, the aggregate change, the aggregate effect on year-to-year inflation has been a reduction of 5 percentage points. The point is that the inflation measure today that comes out of the U.S. government understates inflation meaningfully, and that misleads people in terms of their what they look for in terms of salary or wage increase, and it gives them artificially low return targets for their investments. People get hurt by that. Why did the government do this? It wasn't to help people have a more accurate measure in terms of what they were doing in their private lives. It was all for the government in terms of being able to help reduce its cost or improve its revenues. And the costs there, again, were things such as cost of living adjustments to Social Security. And it also puts people into higher tax brackets than they would have been in otherwise, which increases the tax revenue some. But all in all, it was a gimmick put in place to help improve the federal deficit, budget deficit, and to put that all in perspective in terms of people who receive the Social Security payments. Had these changes not been made, they'd be receiving checks today that are double what they are. That's how much of a difference it has made. But the problems are not just with the inflation. You see changes in the way that unemployment's calculated, and because of the inflation measures, some very big distortions in the broad economic measures.
Also, the GDP deflator is affected by inflation, isn't it?
Yes. The common reporting of GDP is adjusted for inflation. And that makes sense. If you have a high rate of inflation and you're just looking at the nominal numbers, that's before inflation adjustment, there's an element of growth there that's just tied to price increases, not economic growth. So you want to separate the economic growth out from the inflation.
Since we're on the subject of inflation, let's talk about the actual definition of inflation, because we talk about inflation colloquially almost as synonymous to CPI. But wouldn't you say that inflation is the growth in the money supply?
Well, that's the traditional definition. But there's a theoretical definition, and then there's what the average person looks at. I address the common experience and the numbers that actually move the financial markets and against which interest rates are set, and that usually is some measure of consumer inflation.
Of course,
where they measure the cost of goods in terms of the money supply. The relationship between that and the consumer number is not real strong in immediate terms as you look at it. There are all sorts of factors that get involved, and you really have to look at it on a global perspective. And in terms of the United States, where you have a global reserve currency, you also have to look at the money supply not only from the standpoint of what's actually within the U.S. borders, but the overhang of the money supply in the global markets.
Of course, which takes us to the point that money is fungible. It can go anywhere. You cannot control where it goes. So maybe looking at just a small basket of goods for inflation is not enough. Maybe you have to look at capital goods. You have to look at how stock markets are reacting to inflation, to the injections of new money. Or you have to look at the real estate market, for instance.
Yes. Well, those are areas that the real estate, for example, doesn't get reflected in the consumer measure. So the consumer measure really is inadequate, but it is the one that is most widely followed. It is the one that most generally moves the markets, and it is heavily understated in terms of what I would consider to be a realistic measure of the cost of consumer goods due to government shifts in methodologies. In terms of the money supply, it's not well measured. I wish it were. It would make my life a lot easier.
In fact, they stopped reporting M3 in the US.
Well, they did. And before that, they had measure L for liquidity, which I thought was even a better measure. I find that generally the broader the measure, the better its relation to inflation and to broad economic activity. For example, in this, where the Federal Reserve stopped reporting M3 in 2006, didn't really give a good reason. So it said first it didn't provide any more information than M2 did. Where M1 which is basically your cash and checking accounts, and M2 is your savings accounts and small certificates of deposit and such. M3 is M2 plus the large certificates of deposit at institutional money funds and such.
In fact, one of the reasons they gave was that it was too costly to calculate M3. Now, since you at ShadowStats have continued to calculate M3, how costly is it really to calculate M3 when you have the data for M2?
They still publish most of the numbers. I have to do a little modeling with it. It'd be easier if they published all the statistics, but the bulk of it they still publish. So that's nonsense. Why they went that way, I could only speculate. But it was not, again, to give people a better idea of what really is going on. For example, if you look at M2, which is now the Fed's broadest measure, there recently was a period of fairly strong year-to-year growth. But that was not, and when you looked at the broader measure, M3, what was happening was you were seeing a tremendous amount of flight from the large certificates of deposit and the institutional money funds that was going into the accounts in M1 and M2, moving more towards cash, so that as it came out of the M3 accounts, and went into the M2 and below accounts, you saw a relative surge in the M2 and lower accounts. But when you took it to the broader level, there really wasn't a change. So that's why I like to look at the broader measure. Now, we haven't seen an extraordinary period of growth yet in the money supply from the extraordinary easing actions of the Fed. Traditionally, the Fed would use the monetary base as a tool to make the money supply go up or down. But what you have to keep in mind here is that we went through a crisis in 2008, a financial panic, where the banking system was literally at risk of collapse. They weren't kidding about that, and the banks were the big banks were basically insolvent. What the Federal Reserve did at that point in time, and what the U.S. government did at that time, and it was mirrored around the world with different central banks, was that they created, spent, lent, guaranteed whatever money they had to keep the system from collapsing. A collapse of the system was not an option for them. Now, what they did was they bought a little time. The system did not collapse. They pushed the problems into the future, but all that they did then really didn't resolve much. Our banking system still has problems. The economy still is way down, and I think I can demonstrate that it's actually turning down again. Never recovered. Yes. So all the problems that we had in 2008 are still with us, and they're coming to a head again. The reason the broad money supply didn't grow was that as the Fed pumped this tremendous amount of money into the banking system, the banks deposited the excess reserves that resulted from this back in the money base, the monetary base. The monetary base is basically cash in circulation plus bank reserves, and where bank reserves were running around $50-60 billion after the Fed started flooding the system with liquidity. Those bank reserves, and they're mostly excess, topped $1 trillion. We're over $2 trillion now, heading on to $3. And if the money supply responded in a normal manner, you would have seen a tremendous explosion of the money supply. But you didn't. The banks put the cash with the Fed instead of lending it into the stream of commerce, which normally would then give you the expansion of the money supply. The reason the banks did not lend the money was that the banks were severely stressed financially. Their balance sheets were poor. They couldn't lend the money. And we're still seeing problems with the banks being able to lend, at least in the United States, normally into the regular stream of commerce. Now, that means we have an ongoing problem here. Been a lot of publicity recently about the Fed's quantitative easing programs. What's going to happen with that?
Exactly. Do they have an exit strategy? Is it possible to exit quietly with all these excess reserves and the bomb bubble?
Well, they say they do. They try to answer their critics, and Mr. Bernanke had a press conference recently where he was very specific about what was happening. But what you have to keep in mind here is that despite all the talk of, we've got an economic target here, we're trying to bring down the rate of unemployment, we're trying to contain the inflation rate. Well, those are nice things to talk about, and those goals have actually been mandated by the U.S. Congress. The Fed is a central bank. Its primary function is to keep the banking system solvent and liquid. They haven't done a very good job on that. I mean, they prevented a collapse. But all the easing actions that we've seen, all the stimulus supposedly they put forth, has been aimed at keeping the banking system afloat. It's not been to support economic activity or to contain inflation.
Exactly.
Although those are secondary goals, the primary function here, the primary goal, the primary driving force behind the easing has been the banking system. And the Fed has used the weakness in the economy as political cover for the easing. I mean, if the Fed says, "Yeah, we're doing this to keep the big banks afloat," that would not be very popular with the American people. So he talks about, yes, we're doing this, and we're saying we can take some credit for the drop in the unemployment rate, and the unemployment rate gets down to here. Here's our exit strategy. That's nonsense. The Fed is not doing anything to stimulate the economy. If anything, having interest rates as they are is actually counterproductive to the economy. If you had higher interest rates, that would be better for the economy. Banks, if they were able to lend it normally with higher interest rates, would then be able to get a greater margin on their lending, enabling them to take on higher credit risk and see much a greater loan growth, which would then stimulate the money supply and maybe the economy, although that's doubtful. It certainly would tend to stimulate inflation more. But there's a big inflation here hanging in the background that will break, I think, in the not too distant future.
But also,
what the Fed did has not saved the banking system. It hasn't stimulated the economy. All it has done is that it's bought some time.
But also, John, how do low interest rates affect capital formation, growth, and overall long-term savings and capital formation?
Well, let me put it this way: if you live in the United States, it's very difficult to get a safe return on your money that beats the official rate of inflation, let alone what the actual inflation is. So, effectively with negative real interest rates and no safe place to put your money, what you tend to do is, or some people tend to do, is they buy the goods that are inflating. They spend the money, and they actually do better doing that than say buying a treasury bill or such, because they at least have protected themselves on the inflation going forward. Let's say for the next year, it's very bad from an investment standpoint,
and even worse from a savings standpoint.
Well, from a savings standpoint, same thing. If you can't if you can't get a good return on your money, you're more inclined to spend it on consumables or other assets, as opposed to keeping it in a cash-based circumstance. What you have to keep in mind for the U.S. and consumer here, there's an interrelationship with all sorts of factors here. And if you can bear with me just a second, let me hit upon a couple of things very quickly. The economy has not recovered in terms of what's reported with the gross domestic product. The inflation rate has been overstated there. If you correct for the inflation overstatement, what you'll see is that instead of having a plunge in economic activity into 2009 and then seeing the economy rally up to recover fully, I mean, exceed its levels before the recession, in the fourth quarter of 2011, and then continue growing. What happens is after the economy plunges, we basically have seen a period of bottom bouncing, and now the economy is turning down again. The plunge and bottom bouncing is more the common experience than what you see in the official GDP reporting. There's no other major economic series that's published by the U.S. That shows that pattern of recovery.
Just look at industrial production, for instance.
Well, industrial production, it's gone higher. It's now turning lower. It never fully recovered. There are inflation elements there. If you adjust for those, you get the bottom bouncing. If you look at housing starts, you have the plunge and bottom bouncing. Look at consumer confidence, the plunge and bottom bouncing. If you look at median household income, plunge and bottom bouncing. No economic recovery there. You can't, and here's the reason you're not having the recovery. And that is where income is down. The consumer doesn't have the liquidity to fuel an expansion. Household income, median household income adjusted for the government's CPI inflation, the headline inflation, not only is at the low of the current cycle. I mean, after the economy supposedly recovered starting in July of 2009, household income continued to plunge. It's at levels now that are below the late 1960s, early 1970s. The homeowners the consumer is terribly stressed financially. This is a pattern that's been underway for some years, for some decades. Now, income drives consumption, direct relationship. You can't have sustained growth in consumption unless you have sustained growth in income. Alan Greenspan knew that. He saw the problem. You can buy some growth from the future through debt expansion, and that's why he encouraged such a tremendous amount of debt expansion in a decade or so before the panic in 2008.
Yes.
But the debt expansion is only temporary. I mean, that was a long, extended period of time. But as a result of the crash in the credit system, coming out of that, the American consumer has not had the ability to expand his debt as he or she did before, in order to support a declining lifestyle. You hear mention of how consumer credit outstanding is soaring. Well, it is technically, but not from the standpoint that helps people buy automobiles. What you're saying is that all the growth in consumer credit since the 2008 crisis has been due to the government's tremendous expansion of student loans, not in terms of the normal lending to consumers,
which are now defaulting at a huge and increasing rate.
Yes, and you have a big crisis that's brewing there because students have problems paying off the loans.
So John, let's just move on slightly because we don't have much more time. Let's talk about the price of gold and the recent correction and what you understand are the fundamentals of the price of gold. What do you think drives the long-term price of gold, not the day-to-day ups and downs?
Well, long-term would primarily would be inflation. I mean, you have the gold holds is a safe haven for a variety of things, including political upheaval. But over time, it's a solid store of wealth. It preserves the value of assets over an extended period of time against the depreciation of the currency. Now, right now, we have a tremendous inflation crisis that's brewing. All that was done in 2008 to prop up the system has an inflationary cost. The inflationary cost is coming. We haven't seen it yet, but you're going to see very heavy dumping of the dollar, global loss of confidence in the dollar as that hits. You're going to see a big spike in domestic inflation, and coincident with the dollar sell-off, a big spike in gold. Where is the world losing confidence in the dollar? Severalfold. One is the Fed's ongoing debasement of the dollar. That's one reason that Bernanke tried to come forward with his exit strategy, but he made the exit strategy contingent upon the economy recovering to rather overly optimistic economic forecasts that the Fed put out. That's not going to happen. The economy's not recovering. The consumer does not have the ability to fuel consumption, which is more than 70% of the GDP, counts basically for the balance of the GDP as well. So that's the Fed's withdrawal of the quantitative easing is not going to be an issue. The problem is the Fed is most likely going to have to actually expand the quantitative easing. The debasement of the dollar, that's a big factor in the dollar's value and in gold. Second thing, primary long-range insolvency of the U.S. government. If you look at generally accepted accounting principle accounting, and look and take the year-to-year deterioration and the unfunded liabilities on top of the way you'd otherwise account for, let's say, a corporation, pose that on the federal government's finances. The U.S. Treasury publishes statements on that. Last year, the actual deficit was 6.6 trillion on that basis, much worse than commonly reported. That's beyond containment. There's no way they could take everyone's taxes, everyone's income, 100% tax in a given year. They'd still have a deficit there. They could cut every penny of government spending, except for Social Security and Medicare. They'd still be in deficit. Problem is they can't raise taxes enough, and in fact, I think at a tipping point where the higher taxes really do more damage to the economy, and you're not really raising revenues. Politically, they're not going to touch Social Security and Medicare. They've had opportunities to do that. The people currently running the government have steadfastly refused to come to an agreement on that. That they won't even talk about some of the issues that have to be addressed here if the long-range solvency of the United States is to be in place. You saw the heavy dollar selling that took place back in 2011 when they had an impasse and the U.S. was downgraded. They pushed things into the future. They pushed things into the future again in terms of the deficit resolution. Now it's going to be after Labor Day, but there's no way they're going to reach a meaningful agreement here. I think you're going to see a strong reaction in the global markets. Third factor, the U.S. economy. Not recovering, going to be worse. That'll be increasingly obvious. Means the Fed's not going to exit from quantitative easing. So as you see the economy weakening, that's going to be a big negative for the dollar. Fourth factor, and this is one that's not commonly viewed yet, but you look at the circumstance where you're beginning to see scandals hitting the headlines in Washington, and what had generally been a sympathetic press to the current administration has become increasingly critical. I was heavily involved in the currency markets during the Watergate scandal back in the 70s, and I can tell you that day to day, whatever was happening there, anything that was negative news for President Nixon was a big negative for the dollar. The reason being that very key to currency stability is political stability. Anything that threatens that is a negative to the dollar. So the scandals expand. You get special prosecutors, whatever. You have another factor there that will weigh on the dollar. But the big thing, put these factors together, they're all coming together in a confluence. You'll have a very heavy selling against the dollar, dumping of dollar-denominated assets such as treasury bonds. You'll have a lot of dollars repatriated to the United States. This is the big influx of currency from outside the system to into the system. The Fed will have to respond by monetizing all the stuff that's being dumped there. You'll see a big surge in money supply. You'll see a big surge in inflation. And that'll actually trigger very high pace of inflation. And given the circumstance where the United States long-term is bankrupt, you have one of two things that will eventually happen. Either they're going to default on the debt, or they're going to increase the spending. They're going to meet the unfunded spending by effectively printing the money. Most countries choose the latter course. Politically, it's a much more expedient thing to do. Default creates all sorts of long-range problems. Not that the inflation doesn't, but the inflation is politically the more popular, and that what I would expect to see here. So in sum and substance, heavy inflation. The stability here is in gold. That's the long-term store of wealth that'll preserve assets against weakness in the dollar.
So the million-dollar question: when are we going to see the dam bursting and some kind of trigger?
It could happen. It could happen tomorrow. I think you'll see it before the end of the year. It's the type of thing that what will trigger it, a surprise in any of those areas that I've mentioned. And there are going to be a lot of surprises there. There's a lot of negative news to come. How it breaks is anyone's guess, and it's not too predictable. I mean, you might have a little bit of notice on it, but when it breaks, there'll be a tremendous shift in global sentiment in the markets, and the safe haven flight will be to gold.
Right, John. So thank you very much for being on the Gold Money podcast. We hope to have you back soon, and thank you very much for your insights.
You're most welcome, Felix. Be happy to be back anytime.
Subscribe to the Gold Money newsletter at www.goldmoney.com to receive email updates on new articles, videos, and iTunes podcasts from our Gold Research section.